PPI and PPI prints, along with our FOMC statement. This week here, the Fed Fund futures are going to be extremely interesting to keep paying attention to in the intraday timeframes, because in the weeks beginning of last week, we were into June 2026 for a rate cut, and they got pushed all the way out to a year into the future. Now, it has since come from June of 2027 and pulled forward into the future to December 9th of 2026. But a big question about whether we are going to be in a continuation of this intraday rally on the indices, which we are currently in, and whether it's just a squeeze into new resistance, is going to be answered by the Fed Fund futures. And if they continue to price in this cut in December and they keep pushing back out further, or getting pulled forward into the future. And a lot of that has to do with crude oil. And the crude oil short setup that we are in right now is absolutely valid. I mean, we broke through the Globex longs on crude oil and have run right back up into a 50% short from highs. But there are also variations of trading hours long setups that we bounced off of last week. And so you could really think about it in terms of crude oil to inflation to Fed Fund futures to Fed Fund futures to the direction of the indices. And what that is perceived as is that when crude oil goes down, the indices go up. And when crude oil goes up, the indices go down. We're taking a bunch of shortcuts there, but that is what it looks like in simple terms. But those are that's the mechanism of that relationship. Now, why is that important? Because the VIX is technically inside of this massive short. If we break through this long setup at the 86.55, indices take off. We're back, racing back up to our previous all-time highs. But if this VIX pullback defends and we rally away from it, then there are those $159 a barrel oil targets above us. And I think that you could make a case for crude oil support levels. We start to pay attention at 38.2% lines down here. And that's an incredibly important part of our price action here this week. Let's do some backtracking here and go back to our leading indicators. And what you'll notice about DXY is that it's running right back into its original line in the sand that we had on Friday. Did Friday's support levels complete? You could make that case. You certainly could. But of course, we're always very cautious about new draws that happen on Sunday night versus original setups. So we're just using that original line in the sand. The VIX, bank is also, we're going to see where it opens up inside of its resistance. There's the smaller short setup and then the larger resistance. The financials are still inside of shorts. We'll see where we open up there. And then there's the VIX. And this is a little bit complicated, and it is as you're going into the rollover, which is tomorrow. But what we're doing here is we're simulating all of the draws that we have on the continuous contract. So we have the big daily long, and then we have last week's lows to highs, which has a line in the sand at the 23.85. Now, if you go back and you look at the individual, continuous contract. This stream continues at eminiaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.